especially when you're investing in sectors that are extremely nascent. I mean, early stage investing, which is what we do, which is seed and pre-seed and Series A, you're already dealing with a lot of uncertainty. But if you're investing in something like, SaaS, you have business models that are already pretty developed. And in the case of crypto, blockchain, AI, we're still in the early days of not only building out the technology, but also looking at what the potential business models are going to be. It's looking at market pivots, but also mentally resilient to be able to get through, times when the macro environment would have written off these companies and these technologies.
Welcome to the latest episode of the Raise&Exit podcast. Today we have Jalak Jobanputra, who is going to be providing with us with some very interesting insights of being a seasoned investor and somebody who has picked up opportunities in the market that others have missed, and that's how she has made her name. So on that note, Jalak, maybe you can introduce yourself much better than I can. Tell us a little bit about you and your fund, and then we'll dive into some of the themes of our questions today.
Sure, it's great to be here. Thanks for having me. As you mentioned, I'm Jalak Jobanputra. I'm founder and managing partner of Future Perfect Ventures. It's a fund that I launched a little over 10 years ago to invest in what I consider the next internet, or the next big opportunity in the internet, which is the intersection of blockchain, crypto, AI, and IoT. So it's really looking at the proliferation of data that all these devices and mobile connectivity had enabled, over the last 20 years, and then looking at how were we going to actually better utilize that data and analyze that data, store that data, and then distribute and potentially transact with that data, which is where crypto and blockchain came in, and came into that thesis after almost 20 years in the VC sector. I launched my VC career at Intel Capital out in Silicon Valley in the late 90s, and was subsequently at various funds. And before I started FPV, I realized that there were some gaps in the VC market. And as any entrepreneur would do, I decided to launch my own entity. And prior to my venture career, I was a tech, telecom, and media investment banker on Wall Street in New York and London.
So I think that provides such an interesting mix of exposure, because you get the macro view from the investment banking side, you get the deep tech view from the Intel background, but then you also now have 10 plus years of experience of going through several legitimate and at times overhyped spaces. Mm-hmm. So on that note, I would love to kind of go into my first question, which is, how do you work with your fund, your companies that you've invested into, on handling pivots and the market mm-hmm. noise? What's some counsel that you'd recommend to for people to consider?
And that's a great question, especially when you're investing in sectors that are extremely nascent. I mean, early stage investing, which is what we do, which is seed and pre-seed and Series A. You're already dealing with a lot of uncertainty. But if you're investing in something like, SaaS, you have business models that are already pretty developed. And in the case of crypto, blockchain, AI, we're still in the early days of not only building out the technology, but also looking at what the potential business models are going to be. With crypto, there was an additional layer of regulatory uncertainty. And that made it very difficult for entrepreneurs to really survive, the last 10 years where, Bitcoin and crypto was almost, outlawed by many jurisdictions around the world. And we have many portfolio companies that were able to survive because they were nimble. They were very cash conservative, and realized that they needed to be if they had to survive downturns. And so, I think it's very much building a partnership with these entrepreneurs and it's seeing eye to eye. Before we invest, we have a lot of conversations about the way they look at their opportunity, the macro environment, which is extremely important when you do have so much regulatory uncertainty, and then get a sense of how they would be resilient. It's looking at market pivots, but also mentally resilient to be able to get through times when the macro environment would have written off these companies and these technologies.
So Jalak, talking about handling pivot and market noise in your guidance to the founders that you've made investments into, can you unpack a bit more about the nascent notions of technology and how to just tune it out?
The investments we make, and especially if you look at 10 years ago where the crypto and the blockchain spaces were, and even AI, we didn't have any business models yet in many of these sectors. And so not only were we investing at the earliest stages of company formation, at seed and pre-seed, we were also dealing with a significant amount of technology risk, market risk, as well as regulatory risk in the case of crypto. And we really looked for entrepreneurs who had that macro perspective. So we're passionate about building their companies and building out this technology that had so much promise, but we're fully aware that there were going to be a lot of naysayers, that there would be times when they may not have customers, or that governments would be very negative towards what they were building, and still be able to work in partnership with their investors to figure out, how to survive those times. So it was, a very different type of investing than, say, investing in an early stage SaaS company that had business models that are pretty proven, and you go and you talk to potential customers, and then you kind of understand whether this team had the ability to execute. And in this case, there really weren't markets or business models for many of these technologies.
So there's something you, I think, just said right there, which is the difference between the technology, the founding group, and the business model. Mm-hmm. How do you handle those three as part of due diligence? Like, what should founders be thinking about in approaching an investor such as yourself about hitting all those three narratives?
Well, what I always have looked for, regardless of the market, is making sure that the entrepreneur understood the competitive landscape.
So, Jalak, I want to pick up on what you just said there, because I think there is that intersection between the founder, the technology, and the business model that has to be a fit when approaching an investor such as yourself. So how can founders get themselves ready, and what's kind of like the minimum amount of thinking or disclosure that you would expect, or others looking to invest would expect, of the founder having thought this through?
Sure. I mean, the founder and the founding team is always the first thing I look at, mm-hmm. Regardless of the technology or the market. And the founder has to be passionate about what they're doing, and have a reason why they or their team would be the ones that would win, and why the timing is prime for them to do this now. And beyond that, one thing I really look at is to make sure that the founder has a good sense of the competitive landscape. And often, especially, I'd say before there were all these podcasts and the internet, a lot of founders would come to me and say, well, we don't have any competitors. And that shows that there really hasn't been a lot of thought, because you always have competitors, whether it's current competitors or it could be future competitors. So an example is, within the crypto space, and looking at, creating a new crypto brokerage firm, right? If you're successful, you're going to have traditional financial institutions then want to come into your space. So that would be the future competitors, and we've certainly seen that. And maybe it's true that there were no direct competitors at that time in 2012 or 2013, mm-hmm. But also thinking through, well, if this is successful, this is what future competition could look like. And also, in the shorter term, who are some of the folks that could potentially come into the sector? And so that to me shows more of an understanding of not only the market they want, they're in now, but the market they want to be in if they are successful. You always have to look at, okay, this is going to become a multi-billion-dollar business, and then of course it's going to attract competition, and who would those people be?
I think it's so great. The way that I look at it from a more commercial lens is like discussing about it as wallet share, right? Like, hey, what's the share of the wallet? Like, you're going to go and get customers. You're going to be taking some share of their wallet that could have been going to something else. And I think what you're also alluding to is like, you got to understand what's the cascade or the waterfall of how your industry is going to go and evolve, right? I don't have any competition right now. Well, great. Like, if this is a success, you're going to create a competitor. Like, you might truly have the first original idea since ancient times, right? But so going on that notion of understanding your market, how do you also account for the notion of technological longevity? Like, how does a founder kind of understand the technology that they're using may be obsolete within months or years? And like, we're seeing that. Like, look at the rise, how quickly blockchain evolved once a critical mass was there. AI has kind of put that even to shame. So how do you handle that?
Yeah, absolutely, 100%. And I believe the rate of technology development right now far surpasses anything I've seen in my career. And it's only accelerating because of AI and all these AI tools and these AI coding tools. And so even what we saw, emerge 6 months ago around some of the generative AI products are pretty much obsolete now. And so I think that's an added layer, especially these days, that, before it may be 2 or 3 year head start a company could have on any potential competition. Now you're talking months, if that. And so that makes building the moat that much more important, and it could be the technology, it could be the domain expertise the founder has, the network the founder has within a specific domain. So if they're going after the healthcare sector, if they're particularly connected to get customers in the door and get them to from pilot to paying on a shorter time frame, and create stickiness around that model. So sometimes I'm talking to entrepreneurs that are dealing with, focus on the enterprise market, which has longer sales cycles. But once they're in there, there's often a stickiness. If they're able to produce the results the enterprises are looking for. So I'm actually, if you're looking at AI, I'm seeing a lot of these vertical AI solutions that have this deep domain expertise and these industry contacts to then get them to building that moat quicker.
That's really helpful. And I think kind of talking about how the pace of like evolution or the pace of competitive change is accelerating, what would you say are some of the false mantras that are there today in amongst VCs or amongst founders themselves? Like, where are things that you think are still, like, call them like mind viruses that may have been valid 5-10 years ago, but today, like, no, like, you can't use this as a basis of building a company or raising money. So what are some myths that you want to bust?
Well, I think back through when I started Future Perfect Ventures and was so passionate about Bitcoin and crypto and blockchain technology in general. And you had some of the most experienced investors on the West Coast, who said there was no need for any of this. That we had functioning credit cards in the U.S. We had a whole banking system in place, and I think there are a bunch of flaws in that thinking. One is that if you look at globally, the credit card penetration, the underbanked, and even the unbanked in the U.S., there's a significant population there that still needed to be addressed. And could be addressed by reduction of fees and reduction of intermediaries within the banking system. And the other was generational change, right? If I was just looking, I'm Gen X, and if I was just looking at things through the Gen X lens and the way my generation uses technology, I would be missing out on what we're seeing now. And it's really an internet native generation, and then beyond that, mobile native, more real time, no patience for waiting. They had everything at their fingertips right away. So why wouldn't they believe in digital gold?
Yeah.
Why wouldn't they believe in a system that allowed, few fees and instant transfer of money across borders? It just would make sense to them. So, I think like just looking, before the internet, you had like areas of the world that innovated and then areas of the world that consumed. And now that's all more global with open source technology, with with having the proliferation of broadband and smartphones. And so you really have to not limit to kind of what's been done even 10 years ago. It's really like look at the way people may start using some of this technology. And so I think there should be a lot less constraints in the way investors look at potential business models.
So I think what you're also pointing to is the whole notion of timelines, right? Like I do a lot of work with time in what I do professionally. And I feel like not enough people consider that distribution of an idea over time. And look at where we are with blockchain today, right? Like it's now becoming like government endorsed activities, or even governments going and putting their money into it. So I would say your contrarian take from last decade is very much coming to vindication. So I want to build on what you went and said about internet native, mobile native. We're now, I think, going into an AI native audience, right? Like the current generation is growing up AI native. And I think it's actually further separating people that we go and have in the marketplace. So the question that I then go and put to you is, given that you're an investor, you're wanting to go and invest capital so that the companies that you're investing in can scale, generate value, increase in value, you're able to extract that value generation that you've supported by selling. How do you know when on that 10 to 15 year cycle for you to say, you know what, now's the time, let's sell, or hold off, I think it's still coming? What's the signals that a founder should use, or they should have a discussion about with their investors as to whether now's the time to sell to a strategic or private equity or a competitor, or we can still build something and lead the way?
Right. I mean, look, this is an art, not a science. I think there are times when you have very open IPO market. You can tell that the public markets are going to be, at least in the short term, receptive to a company with certain metrics going public, and we've seen that over time. But oftentimes you don't have that complete clarity, and I think it's a conversation that every founder really needs to think about too, because once you're a public company, there's a whole nother set of expectations that are put on the company and the founder and the CEO, if the founder is still the CEO. And that's oftentimes why you see changes in management as companies get to a later stage, because the founder may not be the right person to then take the company public and scale the company post-listing. So I think it's really the investors and the entrepreneurs having a conversation around goals, and this is where even if you're investing at the early stage, I think it's important to have this conversation. If I remember a few years ago, it was not Silicon Valley investors were saying, well, we never talk about exit. Well, I mean, actually, that's one of the first things I think about when I'm investing in a company, because at the end of the day, funds are going to have to realize a return on their capital and their investments. And so at some point, we're going to have to sell our shares. And whether that's through a secondary at a later stage, or at a public market listing, or at an M&A event. So it's really understanding what the founder, how much kind of aptitude and desire the founder has to keep going if it's another 5 years of scaling the company versus taking an offer that just makes sense for them now. Now the investors are going to have their own opinions on that. because we're an early stage investor, we want, we don't invest in anything that we don't see at least a 10x return on potentially. And so we're not going to invest in a founder that would be happy with a 3x exit. And so I think having that alignment makes sense. What we've seen in the last 10 years is a lot of missed opportunities for exits. And some of that comes from boards and investors who, as the funds got larger, that exit number that they needed to hit got larger, and so they wanted the companies to stay private longer and kind of build to higher and higher valuations. But then what happened? The market crashes, and then we're still not. We're starting to see public markets open up again in blockchain and crypto. We've certainly seen some very successful IPOs in the last few months.
Yeah.
But that's, there are a whole bunch of macro factors that go into what the public markets are going to do. I mean, I think I would say the other set of opportunities come when you have nascent technology that larger companies may be trying to catch up on. And we are seeing that within the AI sector, where companies, without business models or revenue or significant revenue are still selling at billion-dollar valuations because these larger companies need the expertise, and they know that trying to hire that expertise, build internal business units will take longer than if they acquired, some of these stronger teams out there. So that's a case. People say, how could that company have sold for $2 billion, $3 billion? But it's really looking at that opportunity cost of getting to market and hiring for some of these larger companies, and they just would rather acquire.
I think that has actually become a much bigger thing, and we've seen in 2025 so much coverage. Right? We've heard like crazy things of like $100 million signing bonuses. I'm like, I'm sorry, did you just go and take somebody from the NBA and put them on your AI team? It's like, no, you're actually trying to go and find an AI engineer. But off of what you said there, I think that is really, really critical, because earlier we talked about like the fit between technology, the founder, and kind of like the business case. But I think it really is also the team. Like, do you have the team that has that appeal? Because sometimes a lot of these companies are being bought because of the fact that they've proven all of these things that are too risky for a larger company, but now it's worth taking it, and it comes with the people along with it. How do you handle valuation that is expertise driven, not just revenue, cash flow multiples, etc.? Are we seeing a shift towards that because of 2025? Should companies start considering what's the value of the expertise that we've built in our team, not just the revenue or the run rate?
Yeah, I mean, but it's not really going to be every company that's able to do that.
For sure, but is that a consideration?
That's one thing that founders will say, well, this company got bought for this much, therefore I am worth this much.
Yeah.
And that's really, I'd say it's more in exceptional cases and exceptional teams, or some of those founders may be connected to that company, may have worked there before, or have 1 or 2 degrees of separation there. So there are a lot of factors that go into those situations, and so I would caution entrepreneurs to not think that they can go that route. That being said, I mean, we've had some companies that have been approached by companies for these preemptive acquisitions, and it's really looking at whether that number seems fair in terms of what the overall opportunity could be down the road. And it's often the number falls a little bit short of that, and some of these companies are still in negotiations, and we may come to agreement there. But it's rare that you'll come in and get this multi-billion-dollar acquisition. I mean, if you look at even Instagram back in the day, right? You can argue that they were what they ended up being worth a lot more than they were acquired for. I mean, it was still a very nice exit for that team, but you're likely to still leave money on the table, but you have to decide where, how much you would be okay with.
So it's interesting what you're pointing to, because Instagram's acquisition by Facebook essentially gave distribution, right? And we've seen a lot of examples of companies being I think, exceptionally valued. And I don't mean like exceptionally like as in wonderful, but I mean exception is outside of the norm, because of the fact that there was that, and I wouldn't say it's product market fit, it was acquired company distribution fit, right? We saw that with SAP and Qualtrics a number of years ago, where their valuation went through the roof because they just got 100,000 enterprise customers that they could sell to overnight. So on that note then, what is something that you feel is a new hypothesis that founders and VCs can consider for the foreseeable future that is valid now that might not have been valid 5 or 10 years ago?
Well, I would go back to actually even at the early stage, looking at, I think a lot of investors are uncomfortable with not having a set business model, in place. And certainly would not have invested in any of these crypto companies, any of these blockchain companies, because of that. And my view has always been, well, if you're building exceptional technology, and it's serving a gap in the market, and so in this case, reduction of intermediaries, that would then open up a whole, big new markets. I mean, just simplistically, taking the unbanked population that then, could have access to investing in U.S. treasuries or investing in Bitcoin or, and then you could build whole new brokerages around that, right? So just looking at, more, kind of leaving that business model, having an idea of where the business models could be, but leaving that off the table, and then, making sure that as an investor, I've been providing guidance to those companies and making introductions along the way. So that I think is important to note.
I love that. That notion that you have to go and have a business model that is reflective of the technology rather than even an evolution over an existing business model. Like, it's absolutely something that commercially makes sense, but I think it's getting you to step outside of the imagination, right? If I remove the intermediary, how would I reconstruct it, right? As you were going and talking about some of the things earlier as well, in terms of like, hey, things are at a much faster pace of change. We have more open source. Look, 40 years ago, you could go and buy an emerging technology company, buy it, kill it, bury it, hide it into the desert because you thought it could take you out in the future. Now, I don't think that's as possible as much. So I love that notion of, it's not just the business model, but I think what you're alluding to is a higher order. If this new business model would work, how it would change the step above, how would it change the vendor ecosystem or the customer ecosystem. You might even have to go higher order. How would it go and affect policy? And that, I think it's all playing out in the past 10, 15 years with respect to the whole blockchain domain, which technologically was developed patent-wise decades ago. So I think it's that piece that's there. Like, so it's imagination, responsible imagination as competitive advantage is my takeaway from speaking with you today. So I think this is really, really cool, Jalak. So I would love for you to, because you've alluded to what you're going to do with your fund, maybe just give a little bit of a who would it be worth everybody's time for to go and say, I'm going to reach out to Jalak and her team because I'm investing in this, I'm building this type of company, and I'm at this stage of my company to raise funds. So quick plug for you and your fund, please.
Yeah, so we're currently investing out of our third fund and have capital to invest. We'd like to get in as early as possible, but we'll certainly do post-seed rounds when it makes sense. And looking for founders that, the way we look at it right now within the blockchain sector, this is a very, very exciting time because we now have that regulatory uncertainty taken off the table. I mean, this is just revolutionary for those of us that have been in the industry for a while. And so we're now seeing a lot of new entrants into this space and entrepreneurs that may have found it too risky to enter and innovate and are now comfortable doing so. So I would encourage any of them. And we invest in infrastructure and applications across the board, and we'll do equity as well as token pre-sales if
Wow.
it's a model to
You're talking terms that the general market has not heard in years.
And then, I'd say, with layering on the AI and the IoT space, the vision, and this is particularly exciting for me, but so the vision 11 years ago, 12 years ago, actually, when I first came up with the thesis, was that these three sectors were going to start to converge. And so, I've been talking to a lot of entrepreneurs who are interested in open source AI, and how do you have data provenance around open source AI, and blockchain technology you can start to verify data, and then you can start to transact with it data. So agentic networks, which is very much in the AI space, but if you start to think of them transacting with each other, we're going to need ledgers and reconciliation, and that's where blockchain can come in. And then IoT is the physical data that's then feeding into these systems. So I'm actually looking at this as prime time of the fund's thesis, and so any entrepreneur innovating and thinking around these areas, I'd love to talk to.
Oh, it's amazing. Jalak, it has been such a pleasure. I loved how you navigated through the technical difficulties we had today and just provide some juicy, juicy tidbits that I think are going to benefit people decades from now, not just in the next few months or years. Thank you again for being a guest on our show.
Well, thanks for having me.